Good morning, everybody, and welcome to Learning Be Accounting. Today, our topic is piecemeal realization in partnership. Now, first of all, what is piecemeal? So, piecemeal means bit by bit, just like we can already see on the screen that piecemeal means bit by bit. So, basically, piecemeal realization happens in a partnership when a partnership is coming to an end and the dissolution of partnership. And an impression has been given throughout our previous study that a dissolution of partnership might happen in one day, whereby we're only giving our net book values of the assets, and then they will also give us our realized values of the assets. So then we will now have to put this into realization accounts and then find the profit or the loss, and then we have to share this profit according to the profit sharing ratio of the partners. That's basically what our previous study of dissolution of partnership has taught us. So thinking on that, you would imagine or you would think that dissolution of partnership only happens in one day, but that is a misconception, because in actual sense, in reality, dissolution takes a long period of time. They cannot just realize all the assets, pay up all the debts in a single day. So it takes a long period of time, and piecemeal realization comes into play when the partners want to be able to share this funds that they have made among themselves as these assets are realized. Putting it in a different form, it's like they want to be able to share the funds among themselves as they realize the assets. So they, first of all, they have to pay all their debts, pay all their liability, and provide for dissolution costs. And then, as they realize the assets, they share these funds among themselves. So now you may ask, how do they share these funds? Is this also based on their profit sharing ratio? We're going to get to that. So now I hope you'll be able to understand what basically the overview what basically the overview is of piecemeal realization. So it's basically a bit by bit sharing of the realizations in a partnership, because the partnership has already come to an end, so they are sharing these funds. So now um there's also something we call interim distributions. So interim distributions is basically those distributions that they make as they realize this asset. So after they've realized assets and then realized the debts that they are being owed, so and then after realizing all these assets, they have to pay up their liabilities. Paying up their liabilities includes their loan, their trade payables, whatever liabilities they have to remember that when a company is coming to an end or firm is coming to an end, they have to pay up all their owings first before they begin to share the leftover funds or share the remaining funds among the partners. So that's basically what they do. So when they do that, when they begin to share those funds as they come in, that's what we call interim distributions. So before we move on to the next piece, I just want to read through. I've basically explained what is already on the screen, but I just want to read through it so that in case some people have not yet caught on with where we are right now. So I said that an impression has been created throughout our study in dissolution of partnership. But dissolution of partnership takes place in one day, and this is not true, because it takes quite some time after the decision to dissolve a partnership for the assets to be sold off and cash to be realized, so and then for partners to be paid off. So the assets may not be realized at the same time, and in fact assets are sold and cash may be realized on piecemeal basis. So you get, so even if the assets have been sold, the cash may come in bit by bit, little by little, on a piecemeal basis. Basically that's what they mean. And then they said similarly, partners may not want to wait and then the assets are realized before being paid off. So the assets are realized even before they are being paid off. So where the above is the case, interim dividends are to be paid. So that's basically what I said. So as these assets are being realized, these interim distributions are the sharings of these funds between the partners. So now we're going to move on to the next parts of the video. Okay, so now before we move on, I just want to say that it is important for interim dividends to be made to partners for the following reasons. The partners may not have may not have contributed capital in the same proportion as to the profits and sharing ratio. The amount realized from the asset may not be received in full. So now I'm going to give us an explanation of what these two reasons mean, but as we move on, we'll see it in a clearer view. So now, the first one being that the partners may not have contributed capital in the same proportion as the profit sharing ratio. We know that sometimes in accounting, a partner might, let's say we have three partners, right? So let's say we have three partners, A, B, and C. And then A, B, and C contributed capital of 200. Okay, now let me write that properly. Let's just turn it to 200, 150 instead. So 200, 150. So now, in this case, the profit sharing ratio can be 1:2:3. Like, their profit sharing ratio is not according to the capital, basically. And remember that in this piecemeal realization, we have to remember that assets is equals to, oh my god, sorry. And so this capital and profit sharing ratio are not accordingly. And then we have to remember that assets is equals to capital plus liabilities. So now, when you realize all the assets and you pay off all the liabilities, what you have left is the capital. So therefore, you cannot just share what you have left after when you realize assets and then you pay off the liabilities. You cannot just share what you have left according to the profit sharing ratio, because it is not according to the way capital was actually contributed. Does that make sense? So this concept, or the understanding of this basically brings about two different methods of piecemeal realization. So now in this video, we're going to be focusing on one of the methods. I'm going to talk about the two of them, but for the calculation, we're just going to be focusing on one of the elements, and I hope you understand basically what this means, so we can move on to the next segment. So capital and the capital contribution and the sharing profit ratio are not always the same. And so now, after realizing the assets and all the liabilities have been paid, what we have left is the capital. So we can't just share this according to the profit sharing ratio, which is this 1:2:3, because if you look at it, they are not going to get the same funds according to the capital that was actually contributed, 200, 150. I hope this makes sense. It's just an illustration for you to understand the next phase of this video, where we talk about the methods of accounting. And so now, the second reason why we give interim dividend is the amount realized from assets may not be received in full. So just like we said, assets may be bought, but all the funds realized from it might not be received in full. So when all these funds realized from it is not received in full, the little that we receive is going to be shared among the partners. So this is a reason why we carry out interim dividend. So right now I'm going to move on to the next segment of this video. I hope you've understood everything I have said so far. So moving on. So now this basically, we're in the next segment. This is basically to introduce the two methods of piecemeal realization. So now, based on what we said about interim dividends, because of the capital contribution is not according to the profit sharing ratio, each interim distribution is to be made to the partners to allow for a partner who has contributed disproportionate amounts of capital. So I'm just going to underline that so we can take notes. Disproportionate amount of capital over the other partners to receive his surplus capital in parity of others. Okay, then at the same time, distribution is conducted in such a way that partners bears his portion of possible loss at each stage of the distribution. So now, to bring a visual concept of what this line we have said is talking about, I'm going to give an illustration. So just like we've said before, that we are realizing assets and then we're paying off our liabilities. So what we should have left is the capital, right? We said that we've realized our assets minus after the liabilities, what we should have left is capital. So therefore, we can't just share this capital according to the profit sharing ratio, because in most cases, their profit sharing ratio is not according to the way capital is actually contributed. Does that make sense? So now, because of it is not according to the way capital is actually contributed, this sharing, so let's just write the illustration of before again, right? This is what we did, and then I think it was 213 as the profit sharing ratio. Okay, now, so in this sense, this sharing should be done in a way that the excess or the surplus capital is paid to the partner who has a disproportionate. It might not be this, it might not be A because he has the most capital, but you get, it might be if there's a way we can find the partner who has a disproportionate amount of capital among the others, but it might not just be the way you look at it, like okay, 200 A should be the highest. No. So we're going to pay the person that has a disproportionate amount of capital, like a surplus amount, pay him the surplus amount first, and then after paying off all the surplus amounts, the remaining balances of the capital are therefore paid according to the profit sharing ratio. So this is going to make more sense when we are actually solving it. I just want to give you a view of this. Does that make sense? So now, so back to what we said. So at the same time, distribution is conducted in such a way that each partner bears his losses. At the same time, we are conducting this distribution in a way that the partner is going to bear his losses, like according to their profit sharing ratio. So in a situation whereby the partners are not able to realize all their assets or realize a particular amount, and then there is a loss, we want to conduct it in a way by this loss is going to be shared among them according to their profit sharing ratio. Does that make sense? So like nobody's going to have more loss than the other person, because if we were to contribute it according to profit sharing ratio, we're going to get to a point that we're going to be done paying C, and then if we're going to get to a point that we're going to be done paying C, and after we're done paying C, A will be left off, and then A might have more loss than he is to bear, and then C might not have any loss at all. But we're going to have to share this in. But we're going to have to share these funds in a way that funds or whatever loss that is made is according to their profit sharing ratio. Does that make sense? So moving on to this, we're going to move on to the next segment of the video, but like I said, the methods, or like I'm introducing the methods of this realization, piecemeal realization, is the surplus capital method and then the assumed loss method. So for this video, we're going to be focusing more on the surplus capital method, and then maybe later we're going to do a video on assumed loss method. So this video, surplus capital method. So now we're going to move on to the main topic, to the main calculations, or we're going to basically explain surplus method first of all, and then we'll move on into the calculation. So let's go. Surplus capital method. Okay, so now this method is adopted when all the partners are known to be solvent. So I'm just going to read out some things in this notes on the screen, and I'm going to outline important things that we're going to need, or we need it. I'm going to outline important things that we need to understand surplus capital method. So the first thing here is the very first line, that it is adopted when all partners are solvent. We're just going to underline it. So you know that in some cases, some partners in partnership, a partner can be bankrupt, a partner can be insolvent. Okay, so in those cases we have to use the other method. That's why it's clearly stated that it is adopted when all partners are solvent. So now moving on, and said it is likely to remain so, and it is likely to remain so throughout the period of dissolution. So that means he's solvent, and that's the end of it. He's not going to. And by this method, the partner's capital account, including their current account, are adjusted to their profit sharing ratio using a base of the capital of the partner who made the least contribution. So now this is something called that we need to remember when we are solving. So I'm just going to underline it. Using the profit sharing, using the base of the partner of the capital of the partner who made the least contribution. So we're just going to underline it. I don't know if you can still clearly see least contribution. So now, so this just basically means you're going to add the capital and the current account, because the company, or the firm is already coming to an end, so they don't need a separate capital or current account. It's all this has to be joined together now, and then okay, they're now reaping what they invested into the company. Does that make sense? So now, excess contribution is ranked for priority of payment. Excess contribution is ranked for priority of payment. So now, what does that mean? So remember that somebody has excess contribution in the firm. He has an excess surplus, and a surplus capital in the firm. So therefore, we have to pay the people, or the person. First of all, pay the person with the surplus capital, and then whoever, if there's any other person with surplus capital, we pay more. We pay those people, and then before we move into the actual sharing, like we start paying everybody according to their profit sharing ratio. So that's why I said excess contribution is ranked for priority payment. So we just understand that one. We don't need to outline it. And then let's say, if there are no more, if there are more than two partners, the calculation is repeated progressively. So now, we have to find the person with the ultimate surplus capital. So you might have 5 partners, 6 partners, 7 partners, 4 partners, 3 partners. No matter how many partners you have to be able to calculate the surplus capital for each partner. You have to calculate the surplus capital, and then keep calculating it repeatedly until you find the one person with the most surplus capital. I call it the ultimate surplus capital, just for fun. But the one person that has the most surplus capital, and then that is the person you start to pay for. That's why they say it is ranked. Okay, so then you say actual cash realized is accumulated and applied in the discharge of claims in the following order. So now, this cash that is realized, you don't just begin to share it among the partners without paying up your liabilities, your partner's loan, and then before you move into the partner surplus capital, and then you start paying them according the basic, and then you start paying based on the partner sharing ratio. So now, first of all, the external liabilities and the partner's loan, you cannot begin to share. Even in a normal business, you cannot begin to share your profits without paying up your losses, without paying up your obligations. You get that? Does that make sense? So you have to pay up your liabilities, your loans, and then you pay the person with the surplus capital before you begin to pay based on the partners, pay the partners based on their profit sharing ratio. So that makes sense. So we're moving into a calculation question, and then we're just going to get it from there. Does that make sense? So we're going on. So before we move into the calculation question, we have to understand the method of surplus capital. So this is the format, basically. This is how we're going to calculate it. So in surplus capital method, if you're given a question in surplus capital method, what you do is you first of all have to prepare your distribution sequence schedule format. This distribution sequence schedule format basically is to give you an idea, or to tell you, it's a must, you have to do this to know the partners with surplus capital. Like, this is the only way you can find out. It follows the step-by-step method for you to derive the partner with the ultimate, or the partner with the ultimate surplus capital. So now, the first thing you have to do, this is the format of it. You have to write in this situation, there are 4 partners, partner A, B, and C, as this is clearly stated. And then you first of all write their capital balances. Right? So this is what is written here. And after writing their capital balances, their current account balances, I told you that this is a dissolution. So obviously they are coming to an end. So there's no need to separate these two accounts anymore. They come together and then you pay off all the money that they have contributed into the business, right? Does that make sense? So now, and then distribution of reserves. So if the firm had made any reserves earlier, you have to share these reserves. So such as general reserve, whatever it is, general reserve. So whatever it is, you have to share these reserves according to the profit sharing ratio of the partners, and then you will now have the total net capital balance. Total net capital balance meaning that this is the capital, or this is the total contribution that they put into the company that you would have to pay off. You and an accountant, basically, maybe an accountant in the partnership firm. So makes sense. So now the next step after getting this total on net capital balance, what do you do next? The next step is to calculate your capital per unit of profit. So now this is, I'm going to go back to what we stated in our definition so we can clearly see this. Remember we said that the partner's capital, including their current account, are adjusted to the profit sharing ratio using a base of the capital of the partner who made the least contribution. So now what we're going to do here is to basically find the partner who made the least contribution, the base of the partner who made the least contribution. So how do we do that? This capital balance if you've gotten here is divided by each of their profit sharing ratios. So now we're not going to go to its calculation, we're going to get a clearer view of it. But now this is going to be divided by the profit sharing ratio of A, and this divided by profit sharing ratio of B. So if this was 1, 2, if this was 1, 2, 3, and 4. So we're going to divide each of these based on their profit sharing ratio of each of them. Does that make sense? So there we can get, so that's basically what they did here. So each of this is written out here. Then this is their profit sharing ratio 1, 2, 3, 4. Okay, adding. Then we get the capital per unit of their profit. So each of them is divided to get the capital per unit of their profit. Does that make sense? So now after doing that, calculate the capital based on the profits or the profit sharing ratio. So after doing that, whatever person that you realize has the smallest capital based on the capital per unit of profits, that person is that person's capital is used as the base. Let me come again. So after doing that, and this is what you get from dividing each of them based on their profit sharing ratio. Whatever you get, the capital per unit of the profit, whoever has the least, the person's capital is used as a base to find the profit sharing ratio. So for example, D has the least, so this is going to be assumed as the least. We're going to use his as the base to find the profit sharing ratio. So basically step 3, like they said here, they say calculate the capital based on the, okay, then I say this is done by multiplying the smallest, calculate the capital based on the profit sharing ratio. This is done by multiplying the smallest capital per unit by the profit sharing ratio. So the smallest capital per unit, let's say now, assuming this is D in this case, we're going to use this to multiply each of their profit sharing ratio to get their assumed proportion of capital. I don't know if that makes sense, but when we do it, we will have a clearer understanding of it. So now the step 4. Step 4 says get the difference between the net capital balance and then the capital based on the profit sharing ratio. So now capital based on profit sharing ratio is that after you've multiplied this list by each of their profit sharing ratio to get a new balance, let's say this is a new balance, you have to get the difference between their original net capital balance and then this assumed proportion of capital per profit sharing ratio. And then this is what they did here, so no need for this whole line. So and then after doing that, the difference is assumed as a surplus. So after doing that, you get the capital That what you do after doing that, the capital minus the capital based on the profit sharing ratio, you get the supposed surplus. So in this case, we have surplus for three of the partners. So this is where they now stated in the definition that because of we have three of them, you have to progressively do everything we have done before until you have only one person. So that's now the ultimate surplus capital. Does that make sense? So now we're going to move on to the next one, and I hope we've understood where we've gotten to. Okay, now this is in second stage or the next part of surplus capital. This is the main actual cash distribution. So now right now we just have the format, and after this format we're going to go into the we're going to get a question and solve on this question and go into the actual calculation of this, so we can see this in a clearer view. Okay, I feel like I'm spending some more time including this format. I just hope this format is really clear, because I really want to break this down so that, because piecemeal is it's a very unique but very simple topic. Like once you get the hang of it, once you understand it, there's no going back. Like I don't think you can ununderstand it or disunderstand it. You get it's very clear once you understand it. So we're going to move forward. Okay, so now just to give an overview of this format before we go into the actual solving, the statement of the actual cash distribution, this is where we're actually distributing it. So now, as you can see here, at this point, this is the cash at bank. So you'll be given a statement of financial position, and obviously you might not have, but in a case where you do have a cash or a bank in the statement of financial position, you have to add it to the cash realized before you actually begin to share this to the creditors. Like I said, this is where our cash, okay, like I said, statement of actual cash distribution. So therefore our cash in our statement of financial position previously, or our bank, is going to be here, and then our very first realization, so the first realization the partnership or the firm makes, is going to be here. So when you add this together, you get a total that the firm will have, right? The total cash that the firm will have right now. So first they do is to pay all the creditors, like we said, all the creditors, then the loan, and then we have to provide for realization expense, the expense incurred in realizing, in dissolving this firm. After doing that, after paying or minusing all this, the cash remaining, you now make from the cash remaining, you now make a distribution to the person with the ultimate surplus. So in this case, A. And then after doing that, the remaining balance is now distributed to A and B in their profit sharing ratio. Then we proceed to the second realization. So when the second realization is made, because you have already paid all this, you don't need to minus them again. That's, you've settled them, now it's between the partners alone. And then we've settled our ultimate surplus to A. So now we focus on the partners. So now there's something that I want us to take note of, but mainly this is going to be distributed to the partners according to their profit sharing ratio. And then when you get the final distribution, or the final realization, sorry, you when you get the final realization, remember that we made a provision for our realization expense or our dissolution expense. So now when we get to our final realization, we now have the total cost of this realization expense. So if it is less, we have to increase this provision, and if it is more, we have to decrease it. So if we made provision for realization previously and it was like 5,000, and at the end of the day the actual cost of realization is 3,000, we have to increase it by 2,000. But in the case whereby the actual cost of realization is 7,000, we increase it by another 2,000 to make it 7,000 from the 5,000 that we made earlier. So now after minusing this, we get the amount that is going to be distributed among 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 their profit sharing ratio. So this amount is now distributed, and then after distributing this amount, we have to add our total cash distribution. Our total cash distribution is basically the total of all the distribution or the cash distribution we've made to them earlier. So we're going to, for A, we're going to add from the minute we made our surplus profit. Sorry, I mean, from which we made our surplus from minutes we distributed his surplus capital down to his very last distribution, sorry, and then you total it, and that you do that for each of them. You total all their cash distribution, every distribution that got to them. After totaling them, sorry, you write down the capital contribution, the original amount of capital that they contributed at the beginning. So that's what's written down here, and then you minus it. So if the total cash distribution, now listen to me very carefully, if the total cash distribution is larger than the capital contribution, then there is a profit on realization. Profit on realization, meaning that the amount of money that they put into the business, being the capital contribution, is less than the amount of money they get back, less than the cash that is distributed to them, then there is a profit. So when your output is more than your input, you are making a profit. But in a situation whereby their capital contribution is more than their cash distribution, whereby they gave in or they imputed more than they received, they are making a loss on realization. So it can be neutral, they can receive the total by which they put in. So in that case, there will be no profit or loss. They all received equally based on what they put into the business. But most times there's either a profit or a loss. Do we get that? So now let's move on. And then also take note that this loss or profits is always in, or as always, according to their profit sharing ratio. Do you get that? So I hope that is clear. So now we're going to actually move to a question and solve this question from start to finish to clearly understand or clearly visualize these concepts, this whole topic. Thank you everyone for watching this video. To watch the next video based on the calculation of the topic we just treated, click on the left button that says watch next, and to check out our previous video based on our suggestions, click on the right button. Please ensure you subscribe for more, like this video, and leave something for us in the comment section. We're waiting for you to reply. Thanks for watching.